Um, but again, with the AI connection is if you're analyzing banks, and I see the risk in banks between it's inexact, but between 200 billion and 900 billion in deposits. So the big ones are too big to fail. So Citi, Wells Fargo, Morgan Stanley, Goldman Sachs, they're too big to fail. We know that.
Rick-
Little banks tend not to fail, but there is this in between level. The large regional banks,
Rick-
again, 200 to 900 billion of deposits, not deemed too big to fail. The most people with money in the bank up to a certain amount, you're like, well, $250,000, it's FDIC insured, and you can have two accounts. The husband and wife can have two separate accounts, and they're both insured, and you can use four different banks, and they're all insured. So you can get up to, with a little bit of paperwork, get up to several $1 million in cash in the bank and CDs and so forth, and have all of it insured if you spread it around the right way. But there are limits to that. 97% of the deposits at Silicon Valley Bank were not FDIC insured. Cisco had a $3 billion deposit. There were crypto exchanges, when they're selling, selling cryptocurrencies and taking dollars. They're putting the dollars in the member bank, like getting it out of the crypto exchange, putting it in a member bank. They had the money there, and I don't even know how many, but scores, if not hundreds, of Silicon Valley startups where maybe you get like an A round and you get $5 million or $10 million in the door, and they had their money at Silicon Valley Bank also. And so what happened? We described the collapse in some detail, but it's like any run on the bank. Although AI did accelerate the crash because we all remember grainy black and white photos of the 1930s, or mostly men in overcoats and fedoras lined up around the block on a rainy day trying to get their money out of the bank. And of course, it was too late. The doors were closed. The insiders had already taken the money. So that's the classic run on the bank. Well, this was no different dynamically, except it was much, much, much faster. You just take your iPhone, a couple swipes or taps, the money's gone. Then you text your friend, hey, get out before it's too late. Everyone's doing the same thing. The network effects kick in. And that bank really went down in 2 days. It wasn't like 2 months of, gee, we got to keep an eye on this. It was literally 2 days. So at 6 p.m. on the Friday, I believe it official was March 10th, as memory serves, 10th or 11th, somewhere in there, but it was a Friday night. At 6 p.m., the FDIC comes out and says, we're closing the bank. Okay. Deposits up to $250,000 are fully insured. Yep, we expect that. Any deposit in excess of that, we're going to give you like a due bill, like a chip, like a receivable certificate. We'll get back to you. And this was, we're not sure what it's worth. We have to sell the assets, figure out the size of the hole in the balance sheet. It'll take time. We'll give you 10 cents on the dollar, 90 cents on the dollar. We don't know. We got to figure it out and haircut the bonds and wipe out the equity and all that. That was the direct descendant of the 2014 G20 meeting in Brisbane, Australia, when they came up with the concept of the bail-in. Everything in 2008, 2009, as you well know, was a bailout, where taxpayer money was used to prop up the banks. And people all over the world, in the United States for sure, but all over the world, were furious. So like, wait, you use my money so Jamie Dimon or some other guy could, woman could keep their, $20 million a year job and their $500 million of stock options. They suffered no pain at all, but used the taxpayer money to do it. So the leaders said, yeah, you're right. So from now on, no more bailouts. It's going to be bail-in. What that means is that a bank in distress, first you wipe out equity. Equity, sorry, you're done. Then you guarantee the insured deposits, 250,000 in the U.S., 100,000 euros in Europe, but whatever it is, okay, you're good for that. Anything in excess of that is at risk. Bonds are going to take a haircut depending on the size of the hole in the balance sheet and so forth. So all the lenders, the bondholders, the uninsured depositors are all going to, and certainly the stockholders are all going to get whacked before a penny of government money is used. And that's what the FDIC said. It's like, hey, nice going. You actually stuck to your deal. Well, then you had what I call the crybaby billionaires. They spent the entire weekend calling the White House, Bill Ackman, all these guys. And they were like, you don't understand. All the startups in Silicon Valley, they all have the money in Silicon Valley Bank. It's all going to be wiped out. They're going to shut their doors. They can't pay their rent. They're going to lay off people. Leaving aside that 90% of those firms fail anyway. But no, that's just a footnote. But the fact is, some of them are winners. Um, and so the White House said, okay. So then at 6 o'clock on Sunday, 48 hours after the bail-in announcement, they said, just kidding, all deposits are insured up to 100%. And beyond that, then the Fed and the Treasury said, oh, by the way, if you're a member bank and you have Treasury notes, send them to us. We'll give you par value. We'll give you 100 cents on the dollar. Now, bear in mind, they were only worth 70 or 80 cents because they had been bought when rates were 2%. Now rates, at least at the time, were closer to 5%. And so the bond value is inverse to the interest rate. So the values were like 70, 80 cents on the dollar. Fed said, we'll give you 100 cents on the dollar, 1 year loan, take the collateral, low interest rate, and see you in a year. And it worked. I mean, there were 5 more bank failures. It was Credit Suisse and First Republic and the Signature Bank, and Silvergate Bank was another one, Silicon Valley Bank. So the big 5. But I thought but things calmed down after that. But I thought to myself, okay, you got through it by guaranteeing every deposit in the system and guaranteeing every Treasury note at par. What else have you got? I mean, what else have you got? And there's nothing left for you to do to deal with the next panic because you've fired all your bullets. There is one thing left, which is to nationalize the banks, and then that's where I kind of leave it, which is there'll be another banking crisis. There already is. The government has used up all their bullets with guaranteeing bonds and deposits, created enormous moral hazard. Moral hazard is people are reckless because they think the government's going to bail them out, and the government usually does, or at least has for 30 years or so. And again, you pointed at this in your books. But again, with the AI connection is if you're analyzing banks, and I see the risk in banks between, it's inexact, but between 200 billion and 900 billion in deposits. So the big ones are too big to fail. So Citi, Wells Fargo, Morgan Stanley, Goldman Sachs, they're too big to fail. We know that. Little banks tend not to fail. They can, but they're much better run. I keep some of my money at a bank that was founded in 1877. I figure, well, if you made it through everything that's happened since 1877, you probably know what you're doing. But there is this in-between level. The large regional banks, again, 200 to 900 billion in deposits, not deemed too big to fail. They may be in the end because now you're into contagion. Banks failed, and that'll spread as typical run on the bank. It's a run on the entire banking system. But I would be, when I talk to clients and others, I say, there are obviously a lot of balance sheet metrics and certainly off-balance sheet information that you look at in evaluating the bank. But I've added a new one to my list, which is the ratio of uninsured to total deposits. What percentage of your total deposits are uninsured? If that number is above 30%, that's a bright red light. If it's above 90%, it's an accident waiting to happen. So you would look at that as well. But again, it's an illustration. There's nothing new about bank panics. They've been around forever. But when you harness it to AI and leave the decision-making to AI, and you get into this feedback loop where the humans are relying on AI, again, we treat it like a friendly advisor, and the AI doesn't have the nuance or the discretion or the judgment you need to fix these things. It just collapses.
Summary. In the intricate world of banking and investments, Jim Rickards offers profound insights into managing financial risks. One critical lesson emerges from the Silicon Valley Bank collapse: the paramount importance of understanding deposit insurance and avoiding concentrated risk. With 97% of Silicon Valley Bank's deposits uninsured, Rickards highlights a dangerous vulnerability that investors can mitigate. He suggests a strategic approach to protecting funds by spreading deposits across multiple banks and staying within FDIC insurance limits. By utilizing clever tactics like using accounts for both husband and wife and leveraging different banking institutions, investors can effectively insure up to $1 million, creating a safety net against potential bank failures. Rickards introduces a compelling new metric for evaluating bank stability: the ratio of uninsured to total deposits. This simple yet powerful evaluation tool provides investors with a clear framework for assessing bank risk. When uninsured deposits exceed 30% of total deposits, it signals a potential warning. And if that percentage climbs above 90%, the bank is essentially a financial disaster waiting to happen. This metric goes beyond traditional balance sheet analysis, offering investors a straightforward method to gauge a bank's underlying fragility and make more informed investment decisions. Perhaps most intriguingly, Rickards identifies a particular risk zone for banks with deposits between $200 billion and $900 billion. These mid-sized institutions occupy a precarious position in the banking ecosystem. They are neither too big to fail like major financial giants such as Citi and Goldman Sachs, nor are they as stable as smaller, long-established local banks with decades of proven resilience. This intermediate category of banks is potentially more susceptible to systemic risks and financial contagion. Investors are advised to exercise extra caution, conducting thorough investigations into the financial health of banks within this size range before making significant deposits or investments. By understanding these nuanced risks, investors can make more strategic and protected financial decisions.